Good afternoon, it's Elena Bonanni speaking. I'm partner of ETicaNews and I welcome you to this second part of Salone SRI. It's an all day of ESG discussion. Just a brief, a quick presentation of our project, of our platform. We are streaming on the Salone SRI platform. You can find all the agenda in the agenda section and all the virtual stand of our partners in the specific section. You can also send us questions, and we are here for this new session of the first session of the afternoon. Key EU action plan development and what they mean for investors. So we are going to talk about a big topic about what's going on in Europe. We are going to see all the binding dates and operating steps that are ahead. I welcome our guests, our speakers, in particular Michelle Lapolla Friedman, Executive Director, MSCI ESG Research, and Frederic Hoogveld, Head of Product Development and Specialist, Amundi ETF Indexing and Smart Beta, Michael Maldener, Managing Director and Conducting Officer, Nordea Investment Funds, and Maria Elena Drew, Director of Research for Responsible Investing, T.Rowe Price. So welcome everybody, thank you for being here. As I was saying before, we are discussing about the path of action plan. There will be operating steps and binding dates, and all these requires major alignment efforts for investors in terms of product classification, in terms of transparency, in terms of identity, ESG identity. And we are asking which tools for monitoring, evaluating assets and products. So we are trying to answer the question, how will taxonomy affect benchmark and investment choices? To start the discussion, I will handle the video. We'll leave the video to Michelle that will share with us an overview of what's going on and MSCI's point of view.
Great, thank you. Let me just get my presentation up. Great. Okay. So thank you, good afternoon, and thank you for the opportunity to speak today. I am Michelle Lapolla Friedman, and I'm the Commercial Product Manager for MSCI ESG Research's Screening, Custom Research, Sustainable Finance, and Impact Solutions. Let me just get to the slide. Okay. So here I want to provide just some background on what we're observing in terms of some of the key regulatory trends in the ESG space. So environmental, social, and governance regulations have been around actually since the early 1900s, long before the term ESG itself existed. But in the past decade, the number of regulations, particularly those enacted by government agencies, has soared. Sorry, I'm having a bit of trouble just getting, being able to go to the next slide. Okay. And so we've also found that investors have increasingly become the targets, increasingly become the target of ESG regulations over the past 10 years. And that's a trend that we saw most pronounced in 2018, due in part to the EU Sustainable Finance Action Plan, of course. And the most common focal points of the new regulations have been for companies and investors to better understand and meet the challenges created by the climate crisis, to promote and incorporate more alternative energy, and to enhance transparency around corporate governance. And for the regulations that are focused on investors, we also see the scope widening in terms of the set of investors who are the targets, noting that in the past, they would most commonly focus on asset owners. And now we see the nature of the regulations also changing, whereas they used to be focused on reporting and largely voluntary, but now we're seeing regulations that are much more prescriptive and focused on doing, that is focused on how asset managers are integrating ESG and sustainability, not if. And the clearest example of such a regulatory effort is the EU Sustainable Finance Package, the most ambitious plan we've seen yet, which really aims to reorient capital flows toward a more sustainable economy, to manage financial risks stemming from climate change, resource depletion, environmental degradation, and social issues, and foster transparency and long-termism. And it's also, the focus is, I think this is key. I talk to our clients globally, and the key component is that this is not just limited to the EU. It has requirements for financial market participants anywhere in the world who market products to EU investors. All right, and now the EU Action Plan on Sustainable Finance comprises really a comprehensive set of legislative streams. There's 10 different action points, but for all of them, underneath them is really an emphasis on transparency, which is coming from the standpoint of investor protections and transparency on risks related to ESG factors that may impact the financial system. It's also driven by concerns about credibility and potential greenwashing of ESG funds, and also of issuers in their reporting, as the EU really seeks to shift capital towards sustainable investments. And there are more and more resources out there that are driving and supporting this transparency imperative. At MSCI, we're committed to this, since we agree with the EU that better transparency and comparability are really going to be fundamental to supporting this shift to sustainable investments. People need to trust and understand what they're investing in, right? So as such, over the past year, we've made a number of new resources freely available and sought to really encourage and support investors in integrating ESG considerations throughout their investment processes. This includes a search tool on our website, providing our ESG fund ratings of over 36,000 multi-asset class mutual funds and ETFs, and also ESG metrics for all of our indexes that are covered by the EU benchmark regulation. And these efforts also followed making publicly available the ESG ratings on the most commonly owned companies worldwide last November. And we've now just also made available a sustainable finance section on our website, which offers information on key sustainable finance initiatives and also links to our own regulatory consultation responses, because there's just consultation after consultation coming out now requesting market feedback. And we think it's really important to not only reply to these, but also share our responses so that we can form consensus in the industry. Going hand in hand with these efforts to improve transparency, we've also looked for ways to make ESG more accessible and intuitive to investors. And to that end, we hired an independent research firm this past summer to survey over 5,000 consumers across 5 EU countries to get their views on sustainable reporting of funds. And what we found is that a rating of ESG performance alone was found to be more useful in understanding the sustainability performance of a fund versus a set of metrics alone. And we think that including ESG ratings in disclosure in the guidance can really provide an intuitive means and comparable means to help investors interpret data, and can also be then enhanced by a core set of meaningful financially relevant indicators. And here I do want to take the opportunity to point out that one of the key challenges that we do find in this drive to transparency via regulation is this concern that even within the EU sustainable finance legislative streams, there are notable inconsistencies in the disclosure requirements, and we feel that this can create the potential for market confusion and costly implementation. So thus the importance, I think, of coalescing around a certain set of key metrics and indicators, at least to start, so that investors have a clear sense of what they're investing in and also can compare across different funds. All right, and with that, I'll just segue over to focusing more specifically on EU sustainable finance and some of these legislative streams I referenced. So there's a number of legislative streams going on simultaneously. And I'm going to provide some background on two of those today, the Green Taxonomy and the Sustainable Finance Disclosure Regulation, or SFDR. Now, the taxonomy, I'm sure you've heard of. I would just talk about it a bit briefly, and I believe our panelists will also share their thoughts. But the taxonomy is a classification framework for assessing activities in order to determine if they're environmentally sustainable. And that is to define what's green and what's not. It's really the cornerstone of the EU Sustainable Finance Package, as it will inform the other legislative streams, including a potential EU eco-label for investment products and the EU Green Bond Standard. The taxonomy covers 6 environmental objectives: climate change mitigation, climate change adaptation, protection of healthy ecosystems, transition to a circular economy, pollution prevention, and sustainable use and protection of water and marine resources. However, currently the focus of the taxonomy is just on the first 2, so climate change and adaptation objectives, and the remaining 4 objectives will be spelled out and defined further by the end of 2021. In terms of compliance and when investors are expected to start reporting against this, financial market participants serving EU investors are required to complete their first set of taxonomy disclosures on a comply or explain basis. Meaning you provide the disclosure or explain why you think it's not relevant, against the first 2 objectives of the taxonomy starting in December 31st, 2021. And then the remaining 4, which will be defined around the end of 2021, they will need to be reported against by the end of 2022. Now, just the basic framework of the taxonomy is to, as I mentioned, to define those economic activities that make a substantial contribution to one of those 6 environmental objectives. So identifying sustainable activities within that set of objectives, starting with the first 2. And then, but also doing additional filters against then essentially screening out from consideration for meeting that sustainable standard if they do significant harm to any of the other environmental objectives, or if they do not meet minimum social safeguards as defined by the 8 fundamental ILO conventions and the OECD's guidelines for multinational enterprises. So the idea is that you don't want companies doing something good in one area, but then doing something negative that might counteract that in another area. And so providing, and I will say that providing this analysis of the taxonomy is a bit challenging because the technical criteria are quite complex, stringent, and difficult to implement based on lack of company disclosures. And that's because they have set quite a high bar for defining sustainable activities. And there is a hope that in a plan, in fact, to encourage additional issuer disclosures to help get more information on this very detailed technical criteria, and we have to start somewhere. So there's a lot of data to work with on this. It's clear where the direction is of the EU, and we'll be building capabilities around that. All right, so I also want to provide a bit of an overview of SFDR. This is the long name for this is Sustainable Finance Disclosure Regulation, and it really aims to harmonize ESG disclosure standards, requiring financial market participants to integrate sustainability risk in the investment process and to report on integration at both an entity and product level. Now, compliance for this stream is due beginning March 2021 for principle-based disclosures regarding how sustainability risks are included in the due diligence and investment decision-making process. And also what's required is an explanation as to whether and how adverse sustainability impacts of investments are considered. And here again, it's sort of a comply or explain basis where if they are not considered, asset managers need to provide a justification as to why. So again, this is getting back to the how you're integrating ESG and sustainability, not if, right? So in addition to that, managers of ESG funds will have to include information on the ESG aims of their funds and publish the methodology they use to assess the ESG impact of the investments that they do select. Additionally, more prescriptive disclosures, these are known as the principal adverse impact statement, that has actually been delayed, likely to January 2022. So the requirements are going to be evolving. There's what you need to do in March 2021, and then that will change and expand over the next year. All right, and finally, to wrap up, sustainable finance really looks to become the biggest regulatory revolution over the coming years, with many different industry stakeholders developing different regulations and standards, and also frameworks to address ESG and climate change integration and disclosure. And we're really tracking these closely and engaging with our clients and regulator on the latest developments. There's a number of different sustainability and climate change research, analytics, reporting tools, and index solutions available to help investors integrate these ESG factors into their investment processes. And we're committed to providing some of those solutions, and specifically solutions that are designed to aid our clients with these different and evolving EU sustainable finance requirements. And with that, I will pause and turn it back over to you, Elena.
Thank you, Michelle. Thank you, Michelle, for, I must say, very clear and useful presentation to get a full picture of what's going on. I mean, there is a lot on fire, we would say in Italian, a lot of things and deadlines and also challenges. I would like to stress your overview, the deep surge in number of regulation and the fact that all investment chain is involved. The impact is not limited to European Union, and one of the key challenge you identified is the lack of disclosure and the inconsistency of disclosure. So with all these on the table, I would like to ask to all our our guests, which is their feelings about this revolution, what are the main challenges we are facing. Who wants can start? Maybe I see Michael, if you want to start with this.
Yes, sure. Thank you, Elena. And also from my side, thank you very much, Michelle, for the very good presentation. And also to our audience, good afternoon, everyone. When looking at the presentation, Michelle, I guess the first thing that was striking me was actually, it was not, to be very honest, a big surprise, was the fact that your research conducted resulted into the fact that consumers, the 5,000 that you've been reaching out to, that they prefer a rating over pure metrics. And I asked myself, why is that? And I guess the quick answer that I came to think of was that since we are facing a highly complex but also time-squeezed regulatory agenda, which means that we are also getting introduced a complete set of new terminology, facts, concepts, approaches. You mentioned a lot of them, so I will not go into detail there again. It is super challenging because it's probably the most challenging area that we as a financial industry are going through right now. At least I cannot remember myself having seen such kind of a regulatory initiative package, which is not only introducing new regulations, but is also changing more or less all the baseline regulations that we used to work with for the last 10, 15, or even 20 years. Now, basically, this being said, it is so complex. Consumers, investors, they, however, would like to have it simple because they need to have something that they understand. And the rating at the end is basically probably what they are looking for, because it boils down this huge complexity of regulatory change to something that is easy for them to understand. Whatever the rating will now look like, whether it's a rating provided by a provider as MSCI and you, Michelle, or basically it's proprietary models, it doesn't probably matter so much, but it's basically about how do we as an asset management industry take this complexity, put it into the products that we actually develop and provide to our clients, and make it in such a meaningful way that basically clients believe that we come across in a credible way and provide them with the output they are looking for. But I guess this rating at the end is also kind of, how can I say, a challenge, because it's basically relying on data. And we know, and you mentioned it yourself, Michelle, that the data challenge is there. We are now facing kind of a regulatory agenda on the EU level, which also looks into things like the NFRD. So we'll get European firms to, or investment companies to look into data from the investee companies in a different way. That will come. But what about beyond EU? As asset managers, we do not stop at the European borders when it comes to investing. Also, there are firms from outside EU who want to sell their products into the EU. So there is basically more to come. And we basically, as an industry, we will have to do our utmost to help pushing to more internationalize the standards that the EU has come up with. So that's probably the first kind of reflection that I came to think of. Now, if we take that and your piece of research again, trying to put it into the context of some of the actions that were listed by the EU in the EU Sustainable Finance Action Plan, one thing that immediately caught my attention was obviously the Action 9, which is basically related to strengthening disclosure and accounting rulemaking. A lot of discussion has been held in the industry about TCFD and SASB. We know also that the EU policymakers, they have been looking at TCFD when drafting, or considering it at least when drafting the NFRD. But yet again, that is basically just focusing on the E aspect, because TCFD is climate, so the E of ESG, and we need a broader concept, because we also need to find ways where basically disclosure on S and G matters is also available for us as asset managers to take this information in, include it into our investment decision-making process, and as such provide the products in a meaningful way to our clients.
Thank you. Michelle, do you want to add something? It's really interesting that the data of the investors more interested in rating than pure metrics. Is there anything you want to add about this?
No, I think you made some great points, Michael, and I agree with those. I think you're right that the preference for the rating is something that just boils down and can be easily interpreted. That they can see a AAA is good and a C is bad, or whatever the scale is. And I think. But also encouragingly, I think that the addition, it makes it even stronger if there's an addition of some key metrics. So carbon footprint or gender diversity or whatever those key metrics are. And there is, the interest does vary depending on the region a little bit. But that can also, I think, start to deepen the understanding of the underlying investments. And I think also your point about there being a limitation in terms of the stream, the NFRD, the non-financial reporting directive, that is the stream that's going to require issuers based in the EU to disclose on the taxonomy and other key metrics. But you're absolutely right, that does not extend outside of the EU border. So it really does raise a challenge. And that's where, I mean, in terms of how we deal with that at MSCI is we take into account disclosure, but we don't rely on it for our models. We are looking for independent sources of data to try to build out that information because we know it's just simply not perfect and may not be anytime soon, right? So I think that taking that into account and not having an overall reliance just on disclosure, because I think that's impractical and also will never provide the full story in terms of what companies report out is not, you really need to look also at independent third-party sources as well, can help to paint the full picture. But I think that those points were really good, and we have found the same.
Okay. I asked also Maria Elena what her feelings and her view about this overview, and what are for you the main challenges we are facing. You need to switch on your microphone, Maria Elena, sorry.
Can you hear me now?
Perfect.
Great. Sorry about that. So I think my colleagues have done a really good job of kind of highlighting the issues. I think what I would say is it's helpful to have indicators for our clients so that they can understand how sustainable is a portfolio. And MSCI, has a service that provides that But at the same time, MSCI has competitors that also provide those services, and sometimes they give a different answer on how sustainable a portfolio is, right? So if you're thinking about a rating, it's something that's subjective. And we find that that can really be quite confusing for clients to be able to interpret, how sustainable is this portfolio? And so I think the addition of having some standard metrics that give a common language for asset managers and asset owners to talk about portfolio sustainability will be very helpful. I think we feel like we're in a pretty good position at T.Rowe to be able to comply with these. And when we get to our presentations, I'll walk you through that. But I would say it is a pretty formidable set of disclosures. And a lot of the data that we have to start reporting is actually not available today. So while the rules will come into place sometime in 2021 and then 2022, it probably is going to take a couple more years for these reports to actually be useful for our clients, because we're going to need to have more and more companies reporting them in a substantive way.
So let's close this first round with Frederic or Michelle. Do you want to add anything about this, or at the end maybe?
Oh, no, I think it's valid points as well. I think that it's really important when you mentioned that there are different providers of ESG ratings, of course. I think there it's really important to understand what the methodology is measuring, because that also will drive those different results. But absolutely, and totally agree that complementing a rating with some really key metrics and expanding those over time seems like a really good way to build consistency and understanding of what is driving this, what is really the sustainability characteristics of a fund or a portfolio.
And Frederic, it's up to you.
Yes, thank you very much. Buongiorno a tutti. So my comment on the background, yes, on this first presentation. So the first thing I wanted to highlight is that sustainability, clearly for us, for Amundi, this is not a revolution. This is something that we have been doing for years and years and years, at least since 2006, when we were one of the founding signatory of the UN PRI. More generally speaking, what I would emphasize is the fact that if this sustainability revolution is happening in Europe, it is because it is really, I would say, in the European DNA to think sustainability and to implement sustainability. And from that perspective, again, I think that we as European have clearly a hedge over the rest of the global competition as far as sustainability topics are concerned. So this is, I would say, a very important message for us. In terms of what I think or what we think regarding this regulatory roller coaster that is coming up in terms of sustainability, I would say three things. The first thing is that from the consumer perspective, it is great news, because this regulatory innovation will help bring more clarity, more transparency on the market, to help them understand whether a product is sustainable or not, because it's true that when you have hundreds and thousands of products that are claiming to be sustainable, it's good to have a regulator, so a European regulator or even a national regulator saying yes, it is sustainable, or no, it is not sustainable. So down the road, in the medium term, it is a great news. It is great news because consumer will have more transparency on the products that they will invest in, and they will also have more products, because together with this regulatory roller coaster, we also see a number of asset managers launching new products. So from the consumer perspective, it is great news again, even though in the short run, the consumer will also have to digest all these new pieces of regulation. From the perspective, I would say, of the asset manager, the product manufacturer, because it's important also to think about us. There are two elements to keep in mind. The first element is that obviously this sustainability revolution will bring a lot of opportunity both for active management and passive management. So it is really the opportunity for asset managers to offer differentiating products that they can market in a different way, because when you market sustainability, you are not talking to your clients only from the perspective of risk and return, but you are also talking to your clients in terms of what is the impact of your investment for society. And this is a very positive message to convey as an asset owner, as an asset manager. It changes the relationship that you have with your clients. So from that perspective, it's also great, and we strongly encourage this regulatory innovation. The drawback, and this is something that is also important to keep in mind, is that it's not a criticism, but it is something to keep in mind, is that with this regulatory innovation could come higher cost in terms of data access, because we need to spend more time to analyze data, because we have an explosion of ESG data on the market at the moment, and we need to understand whether each ESG data point is relevant or not. And once we have analyzed whether we think an ESG data point is relevant or not, we need to source it. That is to say, either to source it by yourself or to buy it from a data provider. And this is something which is relatively costly. So again, from the perspective of asset manager, it is very positive, because it will help us to change also the relationship that we have with our clients. But there are some costs in terms of data, some costs in terms of regulatory alignment, because we will need to change, for example, our prospectus, things like this, and this will take us. This is relatively costly. And finally, the third important element, which is, I would say, the most important element. What is the impact of this sustainability revolution on society, on the planet? And here I would say that we all agree that from the perspective of society and from the perspective of the planet, this sustainability revolution is very positive. I truly believe that through sustainable or responsible investment, we can make the planet a better place, simply by focusing on very critical ESG issues such as climate change or social inequalities. We believe that by being more responsible in the way we invest, we can indeed manage to tackle climate change or social inequality globally. So this is it. These three important points. These 3 points, which are quite important from our perspective.
Thank you, Frederic. And your point on opportunities, but also cost related to this revolution, brings me to my second question for you all. I mean, what you are doing in relation of this regulatory innovation and in terms of processes, products, and strategies. What are you delivering? I would start again with Michael, just to start again.
Yes, sure. And let me put my slide up. Tell me if you can see my screen.
Yes, we can. Maybe.
Is it there? Perfect.
You just have to go full screen.
Yes.
Okay, perfect.
Super. And before I basically want to start talking about how we work with ESG matters in a broader sustainability context, I actually would like to pick up on something that is very important that Frederic just said a minute ago, and that is the impact on society. Because when we look at the flood of regulations that is coming over us, now we have discussed a lot about that, it is important that basically we as a society do not understand this only as a kind of pure compliance exercise. It's much more. What we see as a result of the EU Sustainable Finance Action Plan is actually first time the codification of a societal responsibility for us in the financial industry. So we really have to take this serious, and we really have to take it so that we basically can be proud of having been able to drive change and leave something better to our kids and grandchildren once basically we hand over this planet. But I'm not talking only about the planet from an E perspective, but also, obviously, as Frederic pointed out, certainly the social as well as governance-related aspects. And from that point of view, I guess if I start with what do we do in Nordea? I mean, we have already started last year in 2019 with a dedicated project just around these new regulations, thinking of what do we do, what do we have to do, what can we do, how do we basically support our clients, our distributors, and how do we integrate all we got to do into the way we operate and manage our products. And this is obviously something that is based on a very strong ESG framework that we believe in. We have been actually in Nordea more than 30 years ago. It was actually in 1988, been running the first strategy, which you would consider today being sustainable. Over those more than 30 years, we have built competence and we have built a team which actually today consists of 18 ESG analysts, which is regularly awarded prizes and awards. This, however, in itself doesn't bring you a lot. It gives you a strong foundation, but you also then need to make sure that you feed that framework as well as the personal competence that you have when analyzing data and investment opportunities into your products. And these products, and I have mentioned here just on the next slide, just two basic categories. So we in Nordea, we very much believe in a concept that's just called STARS. It's basically the full ESG integration. So you basically look at the ESG dimension 100% aligned with the financial dimension. We also use thematic strategies, climate being at the forefront, being heavily debated. We just saw as recent as last week that now finally we got the first draft on level 2 on the taxonomy. So much more clarity to come there, which is actually giving us, however, also some headache, because as those being acquainted with the regulatory framework probably know, now we have about 600 pages ahead of us and just 4 weeks in order to respond to the consultation. So it is quite a lot to be done on that front, but something that we are willing to take up. And if we take that further, how do we manifest that in the way we actually operate? And this is not only by thinking about how do we do and how do we work with our products and the ones that you see here, but it's also about we have a mission. And the mission that we firmly believe in, that we have stated for us at Nordea Asset Management, is that we want to deliver returns with responsibilities. And what does that mean? If you allow me for a second, I would like to elaborate on that. Delivering returns means we have the right assets providing excess performance. I guess that is something all of our peers as well would like to do. But on top of that, I guess it's about being an active ESG focused owner, meaning we engage with the companies we invest in. We also want to do that in a very transparent way and also report to our investors. And not only for these products that I have listed here on this slide, but basically on a more broader scale, which is also why the regulatory tsunami that has come over us is actually not so much of a challenge, if I just take it from the outset, because quite a lot of the framework that we had already can actually be used in order to satisfy these needs. On top of that, and with the different products, I guess also worth mentioning is it is very important for us that we maintain an active dialogue with our distributors. Frederic, he actually put it quite nicely, because this is not only a game for us on the asset manager side. This is also very much a distribution topic. And distributors, they are confronted with the same kind of challenges. They also, we know from the leaked MiFID II drafts and documentation there, they will have to integrate sustainability preferences into their suitability assessment going forward. That is a super huge challenge, because there is certain, to a certain degree, uncertainty, if I can put it that way, simply because sustainability preference doesn't basically match what you have in SFDR, because you cannot basically take it one for one. That in itself will actually leave distributors with the question, how do I basically going forward? First, assess the products that I want to offer. Secondly, select the products that I want to offer. And how do I want to position myself towards my clientele, existing and potential prospects, in order to basically distribute these products in the best and meaningful way? This in itself is probably something that a lot of people might think of. This is a governance topic. You need to have the right processes, the right procedures, and off you go. I actually think that this is pretty much short-sighted, simply because if you really want to be at the forefront of ESG, if you really want to be credible to your clients and your distribution partners, you have to make sure that your DNA in terms of ESG is understood throughout the entire value chain of your organization. That basically means that from the investments over to the sales, in between you have back office, they all need to understand what you want to do with your investments and how do you want to create an impact. Only if you achieve that, then I guess also the distributors determining to the most extent the good client experience when facing the client in an advisory session, they can actually deliver to the clients what the client is demanding. So it's not so much only, and I'm just closing the circle to what I said at the beginning, it's not so much only about looking at regulatory compliance, it's also about this bottom-up demand from investors to basically provide them the solutions they're looking for and that they need in order to make an impact with their investments.
Thank you, Michael, and for sharing with us the importance of ESG understanding through all the investment chain, also distributors and financial advisors. And I would say this is a point we are working on for different years during Salone SRI. And later on in the afternoon, we will have a roundtable with some results from the financial advisors in Italy and their understanding about ESG and the relation with clients to deliver what all your work you're doing with products and strategies to the final clients as well. Maria Elena, now I would ask you more or less the same thing to understand what you are doing from this point of view in terms of processes and strategies and products.
Great. Well, as I mentioned before, I think at T.Rowe we feel like we're in a good position to meet all of these new EU ESG disclosure requirements. And I think that's largely because of the foundation that we've been building around ESG. There are two things specifically that we've done, and I think a lot of these are going to echo with what Michael just said as well. The first is we really put a big focus on ESG integration across the entire company. So we did not start by launching ESG-oriented products and then work backwards to integrating ESG across the organization. We really started with integrating ESG across the organization. And we view that as a core capability. It's something that's embedded in our research platform, and we hold all of our analysts and portfolio managers accountable for ESG integration. It's a line item in all their year-end reviews. We've done this by, I guess, investing heavily around this. So we have built a team of analysts that do ESG analysis, and we support our investors. And in addition to that, we've built a technology team that can help us get ESG data onto our analysts and portfolio managers' desktops in a very seamless way. And I think the key thing with ESG integration is that it's critical that you're balancing ESG with financial valuation, industry, macro, every other factor you're going to consider in the investment process. So it has to happen with the analysts and the PMs, right? You can't have this side team of responsible investing or governance analysts making decisions on companies before the analysts and the PMs are able to integrate it. So for us, core from the start was get this data onto their desktops so that it can just seamlessly be integrated in the process. So you can mix ESG with financial data and really come out with material decisions. We then later have started to launch some ESG-oriented products, which I've outlined here on this slide. If we take a step forward, one of the first things we did was we built our own proprietary rating system. And this rating system covers more than 12,500 securities today, and it goes right onto their desktops. So we evaluate companies on 3 pillars: environment, social, and ethics, We then will break down how does a company go about conducting their operations versus the end product that that company makes. And the third column you see there is there to really help our investors understand quickly where the issues could be coming from or the opportunities could be coming from with a specific company. Underneath each one of those lines that you see in the third column is a whole series of data points that we pull in, and we put our own materiality weighting on these. So we pull in different data points for different industries with whatever we think is going to be most relevant to the business case, the business model of that particular industry. But as it pertains to the EU regulations, we actually already do pull in some of the SFDR PIA. And then our product sustainability lines was really our version at trying to get at what the EU taxonomy is eventually going to be providing for us. So in a way, we've already started this process with our investors. Now, if we think about the SFDR requirements, there are 32 PIA indicators we need to be reporting on, and we need to get onto our investors' desktop so they're able to think about them. Some of those, from an investment standpoint, we find to be very material, and as I mentioned, we actually already include them. There's another group of them where not enough companies report that data, so we don't include it today, but it will be great for us when they do start reporting it because that data will become available and we can start using it in a more meaningful way. But then there are also some data points that we don't find to be quite as useful. So for example, some of the data points that we're asked to report on is whether or not a company has a policy in place on a certain subject. I believe one of them is on, do they have a deforestation policy in place? And that's the type of indicator we don't find quite as useful from an investment standpoint, mainly because there's not a ton of heft around it. So we would look more at things like whether or not a company has its assets FSC certified, or for other indicators around deforestation that maybe have a little bit more teeth to them. Just to take a step forward and give you a little bit more color on how we look at things and these indicators, we're pulling in data from several different sources, and we've given you some examples here of the types of data points that we're pulling into our model. So one of the things you can see on this page is supply chain incidents. That's one of the things we're going to have to start reporting on for the SFDR. And then maybe moving forward a bit more, I mentioned at the beginning how important we felt it was to really get ESG data and ESG research seamlessly integrated into our investment process. So what you see here is like a typical company landing page in our research management system at T.Rowe. And there are two things I'll point out. One is, if you look at the research documents, this is where the analyst covering the company is going to write research reports, and you're also going to find research from my team and any engagement that we have with companies. So this is something that we view ESG as very much being a mainstream part of the research process. And then the second thing over on the right-hand side of the page, you can see a little button that says ESG scores. So this lets our analysts and PMs pull up that RIM profile. This is our proprietary rating system for any one of those 12,500 plus companies that we cover. And they're actually, this is an interactive model for them, so they can open and close lines and see all of the individual data points that are feeding the model. We also use the same model to evaluate portfolios. So it will be quite easy for us to be able to adapt this to show our PMs the SFDR and the EU taxonomy profiles of their portfolios. The other thing that we did, which I think will really help us as well, is we've started to make ESG reporting standard for our products. So for all of our European vehicles, we've already completed that process. So we are at least on the way to making it easier to get even more ESG reporting out to our clients.
Thank you, Maria Elena, for your presentation. and a lot of arguments. Interesting. Also, the last one of the reporting is a huge theme to develop now on. With Frederic, I would like to understand what you're doing, but also what's your vision for the future. I mean, what do you get from your dialogue with investors, institutional investors?
Yes, thank you. So what do we see and what do we get from institutional investors? That's a good question. So first, just before addressing your question, just a few words again on who we are and what we've been doing. So as I mentioned earlier, Amundi has been a founding signatory in 2006 of the UN PRI, and since then we have been progressing on our journey towards responsible investing. So much that by 2021 we will become what we call 100% ESG, because ESG policy will apply to 100% of fund management and voting practices. Now, to answer your question, Elena, what do we get from investors in terms of ESG, and what is the message that we receive? The message that we receive from investors is that there is clearly not one size fits all as far as responsible investing is concerned. So what does that mean? There is no one size fits all. That means that depending on the type of investors you are having discussion with, you will have a different definition of what responsible investing is, and you will therefore have a different need in terms of products. So what does that mean? That means that typically, and here I'm being very caricatural, when you talk to large sovereign institution, large pension funds, usually their requirements in terms of responsible investing, at least for their core portfolio holding, and here I'm very specifically saying their core portfolio holding, will be very different from the requirements of wealth management clients as far as their core portfolio holding is concerned. So what do we mean by that? I work on the index platform, on the ETF platform of Amundi, and what we see in terms of ETF requirements, when you talk to large sovereign institutions, large pension funds, the typology of the underlying index will be very different from the typology of the underlying index, which is requested by wealth management client. And this is something that we show on this slide here, and this slide relates only to institutional investors. So you can see, for example, since 2014, the big index investments that were made by sophisticated investors globally. So investors like the GPIF in Japan, like AP4 in Sweden, like the Taiwan Bureau of Labor Fund in Taiwan. You can see that even these investors, all of these investors, they are all large, sophisticated investors. None of them chose to work with the same responsible index, and this is the case because they don't have the same, they don't all have the same vision. So that's the first message that I think it is important to keep in mind. Even though there is at the moment, I would say, some kind of convergence in terms of what you should never invest in terms of responsible investing, and this is typically the case for controversial weapon, companies that are exposed to severe controversies. More and more, we see investors divesting from tobacco, or at least this is the case for Amundi. More and more, we see investors divesting from companies that derive significant revenue from thermal coal or thermal coal-based power generation. So those are, I would say, must-have for responsible investment policy and responsible investment products in order to be sold. But then, depending on who you are in terms of a client, and whether you are looking for impact or whether you are simply looking to improve the overall ESG rating, rating of your portfolio, there will be different client needs. So that's the first message. The second message, and this is a message that I already and we all share here today, is that the demand and the trend for responsible investing is absolutely massive. We measure it quite easily on Amundi ETF platform because we track very closely the flows into ESG ETF. And what you can see when you look at this chart is that over the past 2 years, the flows into ESG ETF have massively increased, and we see this trend for 2020 continue, and we see this trend for 2021 continuing again. From the perspective of index manager, or ETF manager, what we see more and more clients asking from us. So when clients are considering investing into an ESG ETF, they obviously need to look at the index. So what kind of index does the ETF replicates? So how is the index designed? What kind of ESG data are used to build the index? So that's the first thing, obviously, clients want to understand. But the second thing that we see clients more and more willing to understand is the overall engagement and active ownership policy of the asset manager. That is to say, it is not enough to say, look, I have invested in companies that have a good ESG rating and I have not invested in tobacco company. This is the must-have. But on top of that, as an index manager, as an ETF manager, you need to be able to demonstrate that through your engagement policy, through your voting policy, you have positively contributed to company ESG performance. And this is obviously something that we are very much focused on at Amundi. We have a very active ownership policy with two particular areas of focus. Climate change. We do have, I would say, very strong credentials in terms of financing the transitions towards a low carbon economy. So that's the first, I would say, focus of our active ownership approach. And the second focus of our active ownership approach is tackling social inequality. We are indeed particularly focused on tackling social inequalities because we believe that in the long run, social inequalities might lead to political instability, and political instability in turn may lead to financial instability, which are detrimental to investors' return.
Thank you, Frederic. We are running out of time, and I would like to remind people connected to this roundtable that they can go to Stand Partners to ask their questions directly to the asset managers. So we have 2-3 minutes left. If Michelle, you want to close this discussion with some of your remarks on what we have just shared.
Sure, thank you. I enjoyed all the presentations. I think everyone made some good points. I mean, obviously, the EU Sustainable Finance Initiative and the other regulatory initiatives we're seeing, there are challenges with them, right? There's lack of data, there's lack of consistency across some of them, all that. But at the same time, I really like the positivity too, in terms of seeing this really as an opportunity. I mean, I think this can help us all coalesce and focus, and really the goal is to reorient capital towards sustainable investments. And I think that initiatives like this really will push the envelope for the industry to make faster progress on that. And certainly the managers that we have today are very well positioned in terms of having integrated ESG long ago. And this is kind of the latest. There's some additional tweaks and additional requirements that aren't insignificant in terms of reporting, but it's just building on a very strong base in terms of where they already are and where we'd like to see even more financial market participants being. So I think in terms of MSCI, we are very focused on in enabling and helping and supporting our clients, who are many of asset managers, with data, I think we can be an important conduit for sharing what companies disclose, but then, as I mentioned, getting a different third-party data, having a strong signal, creating a strong signal out of those, and being able to provide that so that asset managers can then incorporate that in their own methodologies and decide what is material and report on that, and develop new and really interesting products. So that is our focus, and also on enabling and helping our clients to report out on this. So certainly asset managers are at different places in terms of the level of transparency and reporting that they are already doing, and these initiatives will help to build and flesh that out further, which we think is good for the industry too, because again, the credibility of all of this is really key to funneling and channeling more capital towards sustainable investments. And that's not just on the E side, but as we mentioned, also on the social and governance side, which are equally as important and will help to drive our society towards achieving many of the goals that we have, sustainable development goals, et cetera, and just improving things in terms of our response to the climate crisis as well. So I'll stop there. Thank you very much.
Thank you, Michelle. If there is anything to add from our speakers, I think we are out of time. I thank you all. Thank you, Michael. Thank you, Maria Elena. Thank you, Frederic. And thank you again, Michelle, for being with us. And hope you join all Salone SRI. See you next time.